everyone, and welcome to another edition of Profit Sessions. Today we are going to be speaking about contribution margin. As always, I'm your moderator, Sam Kellett. I am head of marketing at ProfitMetrics, and I'd love to have the rest of the panelists today introduce themselves. Michael?
Perfect. I'm Michael. I'm the founder of Prominence. We're a performance marketing agency headquartered in Belgium. And yeah, we pride ourselves in bringing the financial performance and the performance marketing together for brands. So contribution margin is a topic very close to my heart and very excited to be here.
Thank you, Michael.
Yeah, I'll go next. I'm Damo. I'm the founder of Humble Venture Group and HVG Media. We're a network of expert consultants with backgrounds from TikTok, Google, Meta. And yeah, we also pride ourselves in being okay at financials. Michael is a beast, but we do our best as well.
Yeah, and my name is Frederik. I'm the CEO and founder of ProfitMetrics. And this topic is dear to my heart. Contribution margin, profit, everything with profit. I love it.
All right. Thank you so much, everyone. Well, just to get us started then, why are we talking about contribution margin today? So my question here is, what makes contribution margin such a special, important metric? What's happening in e-commerce that this is becoming such an important thing?
I could start on that one. For us, what we are seeing is just there have been such a big focus on top line revenue and not a very deep understanding of the importance of also making sure that bottom line follows the top line so you can actually invest. And now going into seeing that CPCs, everything is getting more expensive, more competition in the market, you really need to make sure that your profit is actually there to reinvest. We saw a lot like in Corona times, it was all about having enough products in stock because everything could be sold. Then post-Corona, a lot of people were suddenly shifting towards, hey, we need to make a profit. It's not enough. Everything is not converting as before. Now we need to focus on this. And just having a contribution margin, being able to follow that your ad spend, profit after ad spend, if you are selling the product to the right price, are you actually making money after all of those discounts? It's just such an important, not a KPI, because it is essentially a value as I see it, some measured as a percentage, but I see it as a total value. And this is just a great indicator of that the business is healthy and is going the right direction. So it's more important than ever now.
Okay, so success during COVID was more of a, do you have it in stock? Are you able to sell it? And now it's not just about selling it. It's about making sure that when you do sell it, you're making a real profit from it. Thank you. Damo, anything you want to add? Oh, sorry, Michael.
Yeah, sorry. No, I think I just wanted to add that, yeah, I think, Frederik, you absolutely nailed it there with the fact that like during COVID, we saw a lot of propped up demand. Like everybody was at home, couldn't travel, like all budget was for online purchases. And now we're seeing not only pressure on CPMs and CPCs and just diminished buyer behavior, but also with logistics, with US brands now having to handle tariffs and import duties and all those kinds of things. So I think that the cost is up on all sides, both the marketing side and the logistics side, and the demand is down. And so there's more need than ever for e-commerce brands to actually focus on the bottom line.
Yeah, I'll second that, and I don't want to add a bunch of things that have already been said, but I do think there's also slightly, perhaps, why is it coming up now? Contribution margin, GP3, whatever you're calling it internally. I think also the maturity of the industry has gone up as automation has started to take over a lot of the manual tasks that specialists are taking care of, which also opens up the free time of like, all right, I don't have to do manual bidding on every single keyword. What do I do with my time now? And then they go out and they find value and they find tools like ProfitMetrics, which allows to scale it quite easily across a portfolio and teach clients. So I think the time at hand, which maybe wasn't there before and now definitely is also one of the key factors that people are opening up their eyes to. How can I actually go deeper in a business, even inside a actual business? Not to mention all of the clients or customers that came up, the web shops that came up pre-COVID, survived COVID, and now they're like, cool, I've been around for 5 years. How do I become mature? Right? They go from baby stage to like, now they're getting curious. How can I expand?
Yeah, and to that as well is that e-commerce is a little bit odd there, because you wouldn't have a production company without knowing your contribution margin, or a service business. There is just fundamentals. That's where you start, where e-commerce people have been so talented of building actually very large companies, growing revenue, growing sales extremely fast, taking advantage of all the different platforms. But they have come to that point of having a really big business, but they have not really focused on those business fundamentals that in other businesses you start with. You need to have people to produce. You need to know your cost of goods to be able to sell it to a price. It has sometimes been very, very easy to scale a big business without actually going into like understanding, business acumen and so on.
That's a really interesting point, because what accounts for that? Like, what makes it so that e-commerce is the one that you can scale without getting into that? Is it the amount of investor money that there was before COVID, or?
I think it was measurable before. It was like in the past, it was like easy measurable. How much you put in, you get out. If you don't run too many channels, you can actually measure it really fast. So it's easy to reinvest, and it's very short sales cycles as well. So you get the product fast into the stock, so you don't have super big inventory cost always. Of course, you have if you are producing or if you're buying in containers, but it has been very easy to get products fast in, so you can really turn them around very, very fast, and you can then put money in and reinvest them. So you didn't really need so much investment money to actually get started.
Got it.
Absolutely. And to add to that, I also think that e-commerce has this faulty, or there are people in the space, let's put it like that, where you see Shopify screenshots pop up where it's like, oh, we did a $10,000 day, and people are then saying we made $10,000, but no, you have not. You have product cost that needs to be, you have a like inventory that needs to be replenished. You have ad spend that you're not attributing for. You will have returns in a couple of weeks when your product is shipped out, and so I think there's a bad vibe around revenue being the income, but that's not at all the case. And so I think this is also what Damo, what you said, is the maturing of the industry and realizing like, oh, if I ever want to sell this business, now we're talking about a bit more mature brands. If I ever want to sell this business, I'm not going to sell it based on the revenue I'm doing. I need to actually make some profit in order to be able to sell.
Okay, so then if we're talking about how important it is to understand that you're profitable and what's profitable and how you can grow it, who is the person at the e-commerce company or the agency that should be focusing on that? So for e-commerce, who should be focusing on making sure that the campaigns are profitable? For an agency, who should be focusing on making sure the clients are profitable?
And that's essentially a very, very good question, because I think that ownership of it, nobody have really taken. Because if you look at the really large e-commerce companies, there is a CFO. They are owning the contribution margin, or they are owning it internally. But in those mid-sized companies that have grown really fast, this has sometimes been something that the agency should just take care of. But they didn't really have the cost data, so they figured out some kind of ROAS, and then as long as they were hitting that ROAS, everything were good, and nobody was really focusing on it. And then they got a P&L back every quarter, or like an annual return once a year, and then they looked at it, but it wasn't broken down in a way where people could really see where they were making the money or where the opportunities was. And I think that is what is changing, that agencies are maybe focusing the end, so the e-commerce business, to look into this, because they cannot get ads to work, or they cannot do their work if they don't have the profitability to know where to really invest.
I actually think it's a joint responsibility. I think on the client side, the responsibility is to actually understand what it means. And on the agency or freelance or specialist side, it's understanding how to activate it without screwing the business over. Because I've actually had conversations this year where I was sitting at with a client pitching, and then talking about, well, let's dig into the numbers. Like, I'd love to understand what your contribution margin look like. Do you have a lot of returns? All of these things. And I just kind of saw their face go like blank. I'm like, oh no, like if you don't understand these numbers, I'm going to come in here and try to help you on something you have no idea of how to read. It's probably not going to work out. And I'm kind of happy that we didn't do anything with this client, because we usually aim for like our KPI, even on the contract basis, is increasing your actual contribution margin. But if that's my KPI and the client doesn't understand it at all, like, it's just going to be a recipe for failure on both sides, right? They're not going to be happy. I'm going to be like, we're doing great. They're like, you suck. I'm like, oh, we're speaking different languages here. So I think there's a joint responsibility. Internally, you need someone who understands it, and externally, you need someone who can action it. That, in my opinion.
But I think also to that, Damo, that is really what have been the problem, that it has been something that the agencies have been pushing for, because they knew the need of, we need to know where you make profit. What is your high margin products? What is your low margin products? Where can we invest? Because it's their job to invest the ad spend the best. But the e-commerce business have not been able to provide it, so they have like just decided on some ROAS. But now what we can see in our business is it's agencies that are pushing for that strategic part of getting the e-commerce business involved in this, because they need the data. And that is what they also see as, now they have the opportunity, because now it gets actually structured in a way so the e-commerce find that those numbers in and get it structured. But it is being driven by the agency and not the e-commerce business, which is a little bit odd, because they're supposed to be handling the ad spend, not the whole business, because contribution margin is, ad spend is just one part of it.
Absolutely, Frederik. I think that's a really good point. And I want to touch on one thing that you said earlier about the CFO actually taking ownership on that part earlier. I think that's actually from my perspective, and I might get some really angry finance people in my DMs when after this live stream, but I think that's a mistake actually. If brands are leaving it to the CFO to actually own this, because in my experience, finance is always a lagging functionality inside of the business. It's reporting over a past period, and some finance departments do forecasting, but in a very non-marketing driven financial way. And I think ownership is, Damo, like you said, is on the full business taking ownership over this contribution margin. Like, even if, let's say, you're a logistics manager or you're like a COO, like if you can bring costs down by 3-4%, like, I mean, gross profit and increase gross profit by 3-4%, that could have a massive impact on what a campaign can actually do, how much you can spend and still be profitable, and how much more customers you can acquire profitably. And so I think it's on the business as a whole. Every team member actually has an opportunity to aid in contribution margin.
Okay.
I just have some. That is the point of it, because if Damo or you are driving ads, it's all about, when have they last negotiated that shipping? Are they giving free shipping on too many of the orders where it makes no sense? It's actually not converting any higher. Are they giving free returns? All of these things. When can they maybe buy in those 5-10% of the products that have 80% of the sales to a better price, or conversion rate optimization? When we send the traffic, can we get more people that we already paid for to buy more, or buy more often, or certain things? So it's contribution margin is just, it's a value that everyone, if you're procurement, if you're a website developer, if you're conversion rate optimization, or it's the one handling Meta or Google, everyone is working towards the same thing, and everyone can impact it in a good way or a bad way. But it's such a good leading indicator of a healthy business going forward.
And if you're tracking it properly, like whether you're using a tool or doing it in a sheet, but if you're tracking it properly, everyone can look at that same number, and there's no misunderstanding. Like, oh, but the ROAS is this, and the Klaviyo open rate is that, and the convert. No, everyone can look at the same number and say, okay, how are we going to improve this towards next quarter and towards the next fiscal year? And everyone can set goals based on this one number.
It's comparable. There is, it's back-end numbers. That's the same with if they are measuring on revenue, if I ask 90% of all e-commerce business, that revenue you're getting from Google, is it including VAT or excluding VAT? They don't have an answer like this. This is in most countries 20 to 25% difference, where a contribution margin is just clear. There's no VAT. This is what we made in profit after variable cost of orders and ad spend. This is a number that is comparable. We can get it actually back in time as well because they have it in the P&L, but it's just there is not enough focus on it.
So regardless of who's driving it, who's running it, every department can contribute to contribution margin. Sure, there's a pun to be made there. We don't have time to get into it now. But, just before we go further, I think you basically said it right there, Frederik. But for people who are unsure, can you give me a quick definition of what are we talking about when we talk about contribution margin?
There is always different definitions of how you look at it. But as I see it, you look at revenue ex VAT after discount, what is coming in. Then you break it up with all the variable order costs like cost of goods, shipping, payment fees, handling cost, returns. And then that's the gross profit. And then you have the contribution margin, which then take away all the expenses towards selling and getting that sales in. So that could be, if you had a business where you have salespeople, that could maybe be in there, but otherwise it would be all kind of ad spend that would be in there. And then you have your contribution margin. So it's before fixed cost. It's not paying the salaries. In some cases, agencies could be in there if they are on some performance agreement, but otherwise that's in many cases a fixed fee. So that should not be in there either, in my opinion. But warehouse offices and so on, leases and so on, that should not be in that because it's not impacted. If you have 5 people on the warehouse, whether they have 200 orders or 150 orders a day to pack, they cost the same. You're paying them the same unless you're using a 3PL where you're paying per order being packed. So it's all the variable costs associated with the sale of that revenue.
So essentially, your gross profit, and then you subtract any of the sales costs. So if you're an e-commerce business, gross profit minus your ad spend to find your contribution margin, but not including the fixed costs, which would then be your net profit. Okay. And I did want to get just a sense.
I know Damo has another definition of it.
Oh, okay, wait. Sorry, Damo. Don't let me stop you.
He's Swedish.
Bring in your alternate definition.
No, I agree with most of it. There's a few things I would like to contest in some scenarios, which is returns. Sometimes returns are very hard to include into GP3, gross profit level 3, or contribution margin, as some people know it as. Depends what you call it, potato. But returns in particular are very tricky to deal with, because if you're selling a very broad inventory, you can really mess that up by taking an average return rate, especially if you're like buying in new seasonal items that maybe have a higher return rate or lower return rate than the average. So counting return rate, in my opinion, if you are multi-brand, multi-SKU e-com, can be dangerous at that particular point. I would rather look at that like after the return period is over and then look back into it. That's my opinion, though. Some people will disagree.
But I actually totally agree with that, because we are right now looking into or implementing the returns and focusing on that. And that is also where you actually want to see, in my opinion, the sales without the return. What happened? How were everything impacted without the returns? But then you want to break down and see the returns. And then there is 2 ways for me to see returns, because if we're looking at Shopify, the big problem with Shopify is it does it as a financial. If you go to the CFO, you're selling a lot in January sales. Everything looks good. February is normally a lower month, but also all the returns come in February, so it gets even worse. And that is the right way of looking at accounting, because that's the cash flow of it. That's how you would do the accounting of a credit note. But as a marketer, and maybe as looking at real performance in January, you want to see the breakdown of return when you take it back to the order point or time of that order, how much got returned in January later on. So you can, but I definitely believe that you need to be able to have a visual picture without it, because marketing has of course, marketing can impact of what products they sell, but it could be a bad product, it could be a bad product size, and so on. So you want to see the picture with and without, and also by time. That is at least how we are going to implement it, because it doesn't work if you only see it when it actually comes. Like, that's how you would see it in a financial system. You will see that's the point of you paying back the money.
It's a lagging indicator. It's exactly what Dan, what you touched on. Like, I think fashion, for example, is a niche where this is very is felt very hard. And we have some fashion clients, and we know that when they are on sale for let's say a couple of weeks or a month, as it sometimes happens in Belgium and the Netherlands, what we see is that, okay, we have a really good month, and then the next month looks absolutely horrible, but it looks much worse than it actually is, because you're dealing with all of these returns from people that bought last month. And you even see it in the orders, people buying the same product in 3 different sizes. You know that 2/3 of that order is coming back. And I think I think even it would even make sense to actually try and, as an agency or as an e-commerce business, try to factor in, okay, we got 10 orders going out today. I'm just taking an arbitrary number. How much of that revenue is going to be returns, and proactively try to filter it in, which is very difficult, because like Damo, like you said, it's very difficult to predict return rate and the impact on revenue with, like, if you're selling 10,000 SKUs.
Yeah, and even adjustments in everyone is talking about then going in adjusting in Google afterwards. The problem is many e-commerce businesses have more than 30 days return rate, so they could actually be past the attribution window, but of which most maybe have 30 days there. But it can also just be that if it comes in 3 weeks later, Google is already, it's 1-2 sales cycles. It's actually not impacting and bending the algorithm enough, because it's down on a product. What is the correlation between this return? So definitely some kind of forecast where you're essentially, if you're bidding for it, removing some of the potential return before you send it to Google. But again, how accurate can you make that return prediction? How much data do you have? How is the seasonality? It can be super dangerous. But just when you look at the contribution margin, looking at it before, after, but also looking at it in the right period, because I had a lot of Christmas sales in my e-commerce business, my past e-commerce business. January was so crappy always. The P&L looked like crap, but November and December, oh my God, they were amazing. But it was just products being returned there where I had to pay back the money. And of course, the product came into the inventory cost again, or the inventory levels, but still the profit went out in January. But I would love to have seen, okay, how was December and November actually performing if I looked at it minus the returns coming back later. So I think it should be in the contribution margin, but it should be possible to take it out and in to see the picture with and without.
But I think the discrepancy that you're pointing toward right now is something that we're seeing happen with a large part of overhead. Like, we're now saying, like, okay, returns, should that actually be counted towards overhead, towards contribution margin, yes or no? But we see a lot of companies actually trying to achieve where your overhead is expressed as a variable, as a percentage of revenue, or as a variable cost. And so I think over the next few years, what we'll see is that contribution margin and net profit are going to get closer and closer together as companies try to manage their overhead better by trying to express it in some way as a variable cost, which would then put it in the equation for contribution margin.
Yeah, and if you're looking at that as well, in an e-commerce business, the 2 hardest thing is, how many people do you have on the warehouse? How is the volume? You always have either too many orders in a period or too little, and then they're busy or too busy, and then sometimes they don't have enough. But the same you have with customer support, and that's also where we're seeing all the automation with AI, where that is essentially knowing, okay, even if you paid a lot of money for an AI tool that could take some of that, that's where it can take that overhead, that you don't have too many people in certain periods and too few people. So I also think in that case, more of that will go over to becoming some kind of variable cost that could go into warehouse is difficult, but maybe 3PL will get like a new way where more people will use it. I don't see that many. I know in Sweden it's very, very big 3PL, but I don't see many in Denmark and Netherlands really focusing on 3PL. They have their own warehouses most often.
Okay. I mean, it sounds like we've got a lot a lot of opinions on bringing the return rates in and when we can do it and if we can do it and what we're measuring. I want to pull us back out a little bit for a second and just get a sense of, let's say I'm an e-commerce company and I can see my contribution margin. Can you tell me more about what a rising contribution margin would tell me about the flow of my company, or what a sinking one would say?
I'd love to pitch in here like quickly, because I when I was preparing for the call, obviously, and thinking about this question as well, is that I think the rising contribution margin or a diminishing contribution margin in isolation does not really tell you anything about how your company is performing, I think. And that's also what we try to reflect when we work with clients, is I think it's only relevant compared to target. And I'll give you a very clear example for the month of October, which is very often like a month where e-commerce brands are starting to fill the funnel for Black Friday. And so your contribution margin should be diminishing, because you are actually building that awareness, building that recognition for your brand when Black Friday comes around or when the holiday period comes around. So I think, yes, obviously you want to see your contribution margin go up and to the right, but I think it makes the most sense in relationship to the target and relationship to your context. And maybe you want to sometimes offer up some short-term contribution margin to make it better in the long term. But I think you need to be super clear on that as a company, and you also need to be super clear on that with your agency partners, with your in-house team, and make sure that you're all on the same page there.
Yeah, and when you get it back, that's also the important thing, like bidding maybe more aggressively on new customers, making sure these customers come back, but also when are you expecting to get it back? Because, for example, the January sale, often that is maybe not a super high contribution month, even though revenues are super high, but it has a purpose of liquidating a lot of stock that now we have cash for buying in new, if it was a fashion company, new styles in and so on. So it has a point. So if you go down and dip down in contribution margin, either it has a strategic, there is a strategic decisions behind it, or else you need to understand if you are maybe very aggressive on ad spend, often the contribution margin goes down shortly. But when are you actually making it up? And is there a play for that to maybe go 1 or 2 years where you are super aggressive because you're building up a fan base in the business? But you need to know when it's coming back. At some point, the contribution margin needs to go up from a dip. Otherwise, it's not so healthy.
So from a bidding perspective, then, if you're going for volume, you could set a lower target, expecting a reduced contribution margin because you're going to be getting more volume from it, and then vice versa?
Yeah, from what I'm also, if we just wanted to increase the contribution margin in October, even though that's essentially a month where maybe it dips a bit, going lower funnel into all the retargeting, doing a lot of emails and, trying to push up the target ROAS or POAS, then you can get a higher contribution margin. But in that point, maybe you'll take a bigger dip later on because you're not getting that percentage of new customers into the business, because some customers will always be leaving you churning. So you need to have a certain percentage of new customers coming in, and those customers most likely cost a little bit more. So you need to have that mix in. But that was post-corona. What often happened there, we saw that people just needed to make as much profit as possible. So, the ad spend went to retargeting in Meta. They went to a lot of brand search, a very low funnel. But at some point that, that wet sponge, there was no more water in it. There was nothing dripping, there was no more customers to retarget. And then it gets extremely expensive to get a ton of new customers in at the same point. And that's what actually killed a lot of businesses, because they just focused so much on profitability here and now, and they didn't get that mix in of buying new customers that should return in the future, which they have done in the past.
Got it. So make sure your sponge is wet enough to cover the next few months. I'll think of a better analogy. We'll add in another analogy there. Okay, now we touched on this a little bit earlier, but in terms of using contribution margin as the main success metric for your company, the thing that everyone should be optimizing toward, what makes it a better success metric than revenue or ROAS?
I can take this one if you'd like. I really like what Michael said about contribution margin only makes sense when you talk about the target, right? So it really depends on what the target is. ROAS is really good if you have, for example, very similar margins across everything. Then it's absolutely an okay KPI to go for, because you can like evaluate your contribution margin somewhat based on the ROAS already. Like if you're a D2C brand and all of your products that you're selling have 80% to 75% margin, well, maybe contribution margin is not going to be like a crazy unlock for you. But if you are someone that has very varying margins, then it becomes really important to understand how much money am I going to have left by the end of the month after all of my variable expenses to move my stock. That's going to be one thing. But also, what am I supposed to do with the money that's left on the table? And I've had conversations where we look at the actual amount left, the gross profit 3 left on the table, like after all the expenses. We're like, it increased. And then I'll talk to the CEO and he'll be like, but my percentage went down. And then I'm like, yeah, but does that matter? Like, do you actually care about, you went from 15% to 10%, but you have 50,000 more to put in your pocket? He's like, well, no.
Let's answer that for once and for all, for everyone that's seeing this. It does not matter. Like, percentages don't pay the bills. You can't, like, have you ever pulled out your wallet and like, here's 3%? Like, it does not matter.
Exactly.
So true. So
yeah.
true.
So I would say really you have to understand that, like that, just like Michael's saying, what actually pays the bills, and what is your actual success. And then now that you have some money left on the table, what do you do with it? And just like you were talking about, like then we start talking about targets, like should we focus on new customer acquisition? How much can we pay for a new customer? And if I'm paying for a customer that I expect to deliver X amount in the future, how long can I wait for that future? Because that's also a really important question to ask and to understand. Because sometimes, someone will look at Shopify, they'll be like, I have this many customers, I have this much revenue, and they'll just take 2 years. And they'll be like, well, things have happened during 2 years. You're selling more items, your lifetime value might actually have gone up over the last few months. Maybe Shopify counts the same customer multiple times, because they actually do. They count one per email address. There's so many variables that are not taken into account, and people are just like, oh, that's my CLV. That's what I should aim for. And I'll aim to get that back in a year. But they forget to ask the question, can you wait a year? Many can't. And it's like you have to sometimes just stop and ask yourself the right questions and understand that you're not mature enough to take decisions based on, that much. It's as if all of us would go to, I don't know, Mercedes with a nice American Express card, and we're like, let me cash out the AMG, let me get it. The dealer will be like, yeah, of course, your money, your choice. But the reality is we can't afford it yet. And we should probably wait and save up some cash before we do it.
Yeah, I love that. And I think there's a couple of things to unpack there. So if I can just quickly build on that, I think from my perspective, like ROAS is the worst metric to be looking at and to making decisions on a day-to-day basis. And I think it's exactly for what Frederik touched on earlier. It's like, oh, we need to make more money. Let's think about some campaigns. Oh, this retargeting campaign at an 8 ROAS looks really good. But that audience is, first of all, that's going to be tapped out really quickly. So the additional profit, not in a percentage, but as Damo said, the actual additional profit is going to be limited. Secondly, if you're focusing a lot on retargeting, you're not really creating new orders. You're just pulling orders forward from the future, and you're just moving your problem like 2 or 3 months away, which for some businesses, if you're in a cash flow need, that might be the right decision. But in general, it's not a good growth strategy. So from there, you're left with revenue and contribution margin. And I think we work with contribution margin. We put it front and center. But contribution margin also needs to serve the goal of the business. We have one client, and he always was touching on these revenue goals, and I was actually showing that even though we weren't hitting revenue goals, we were doing a lot better in contribution margin. And at some point I just asked him, like, can I ask a straightforward question? Like, is the revenue goal like some type of ego thing? And he thought about it and he said, yeah, it is. He wanted to hit that revenue number. And so we can debate on whether that's the right thing to do or not. But at the end of the day, like you're serving the bigger goal of the business. If the business wants to sell in 2 years, you're probably going to be less aggressive, scale less hard, take more profit. Versus if you're still in full growth mode, you might want to go all the way to break even or maybe slightly unprofitable on new customers because you know that's paying off in the future. Or sorry, you hope that's paying off in the future. Let's put it like that.
Yeah, and I think also to touch upon that is that ROAS and also POAS, even though I always talk about POAS, but ROAS and POAS are not something you pay your bills with. Again, it's POAS and ROAS is how much you put in to get something back. It's to have a target that you are optimizing for, and it has nothing. It's not including anything about the volume. So a POAS of 2 euros back in profit every time you use a euro is not necessarily better than 1.5, because what if 1.5 made you be in more auctions or more visibility, you got more sales, maybe you got 50% more revenue in there. So maybe percentage wise you're making less per euro coming in revenue, but the overall volume of it is higher. And that is what you can see in the contribution margin. That is the final measurement of these things, where people are focusing on it. You cannot measure the business on a POAS or ROAS. That's a way to get to something you measure the business on, and I think that's where a lot of people go wrong. What is the right ROAS, or what is a good ROAS or good POAS? You cannot say that. It depends on how much contribution margin or what goal, how many new customers comes in, so we get contribution margin in the future. That is what the goal is, not what is the target you're hitting in those two terms.
We actually use a sensitivity table to show all of our clients. Like it's just a big Google sheet basically where we're showing like, okay, lower efficiency can mean more profit if the revenue that you're creating is disproportional to the additional ad spend that you're spending. And that's what a lot of like you said, most companies are like, we need a 250% new customer ROAS or just blended ROAS or whatever. But then we go look and yes, but if you can bring it down to 230, you only need X amount of extra revenue and you're already making more profit. Would that not be worth it? And the answer is obviously yes.
Yeah, and you can actually go a step further in the contribution margin, and also when you're talking about targets, then you also have those overheads, so the fixed cost of what contribution margin or what volume are you driving with the target ROAS or POAS to get to a point where those 5 people in the warehouse, they have enough packages, so they are not overworked, but they have enough to do. The customer support has enough tickets coming in, but also looking at where do you need to increase those people, or you need a bigger warehouse. So those also go a little bit into the target. How much capacity do you actually have in the business before you need to increase headcounts or whatever cost it is there. So contribution margin goes so well of planning together with your fixed overhead costs.
And there's one more thing, which is actually pressing for one client that I'm working with right now. So they're in like the supplement and health space, and obviously there's quite a few quite big brands, and they're a retailer or a reseller of these brands. And I went to meet them in the warehouse, the office recently, and we were talking about 3 of these brands that are like market dominant. Like most people that are into supplements know about these brands. And usually that means you have really, really shitty margins, like because they're big, they're popular, they're like, oh yeah, here, 20% margin, that's all you get, and they had these items because they only have 20% margin on them. Then we start looking at the sales. We're like, oh, we're selling really bad on these super popular brands. We're like, all right, let's dig into it. And then thanks to understanding the contribution margin together with the client, we can now look at the pricing as well of the items. And then we see, oh, actually, because of the shitty margins, we're pricing ourselves way higher than everyone else. I was like, well, how do you expect that we're going to sell if we're more expensive than everyone else. And currently, for a very popular brand that's essentially a commodity, it's a zero-sum game, and we're playing at the worst position. We're definitely not going to win this game. So how do we turn that around to make the shitty margins a USP for us? And what we've decided to do instead is let's match the market, and we will be like at almost no percentage of actual margin, but let's make sure that we act on it and only focus on new customers for these particular items, which also allows us then to leverage away some of the cost and the profits into buying only new customers on the items that we have really poor margins on. But if you don't understand the contribution margin, if you don't understand how to talk about this with the client, like, good luck. They would never be like, oh yeah, let's match this and have no margins on items. But when you can show them the numbers and be like, you're not making money anyways because it's not moving from the stock, then this becomes an interesting topic.
And I mean, that's really interesting because that's bringing in what we were saying before about every different department contributing to contribution margin. Because there you have the people setting pricing that are able to be like, okay, well, we can help you fix this problem. And that's...
Yeah, and also to that, if you know these products where you have a shitty margin because there's so much competition, I know many of these brands because I come from that industry. But if you know and can actually see that those new customers are coming back, that's where you can play around with the contribution margin, because into the contribution margin or getting that new customer, there is a high acquisition cost, most likely because the competition is fierce, the click prices or the impressions on Meta are super expensive. But that's where you can maybe afford selling them cheap to get customers back again and again, because if you're really good at reselling them through not paid channels like email or whatever you're using, SMS, then suddenly you actually have a higher contribution margin because you don't have that ad cost when you get ahead. But you need to understand that these products actually get people back. If it's just something where people go in and buy once and then they go to the next site who have it the cheapest again and they're not coming back, maybe that's not a good business. But in most cases, it's getting them in the door and then reselling them on something else, or more of that again, just without ad spend.
So to put it in classical marketing terms, it's about getting the sponge as wet as you can so that you can then sell to them later. All right, sorry, I had to get that one in one more time. All right, so we've talked a lot about contribution margin, what makes it important, how to define it, what it is. For an e-commerce company that is currently not working with it, how can they start to make the switch? Like if they've only been measuring revenue or ROAS, where do you start to begin using contribution margin with your e-commerce company?
Is that me?
Why don't you start us off there, Frederik?
But of course, we have a tool where you can set it up very easily, and not to. Maybe for some, there is just another start where you don't need a tool. Of course, it's much easier because we structure it in a way. But I think it all starts with you have most of these numbers, because otherwise you cannot make a P&L. It's law in every single country that you need to make an annual return. So you have these numbers, but it's about being able to structure them, because many times an accountant, when they make your the way you structure a P&L, then sometimes ad spend is within the gross profit. Sometimes some of the fixed costs are in that gross profit. You need to structure it in a way so you can actually see what is us selling products to a lower margin or using a lot of discounts. What is us increasing ad spend? So doing something where maybe it's in, I know Michael, he's a wizard in spreadsheets, but getting that structure in so you have a way to be able to see it over time, how it evolves or changes depending on what you're doing in the business, changing prices, buying in better allocation of ad budgets and so on. I think it's all about starting with structuring it in a way where you can actually read a P&L and the real contribution margin structure that way.
And to be fair, Frederik, often the spreadsheet numbers are just taken from the ProfitMetrics dashboard. It's just a different way of looking at it.
So you can do it with relative ease with ProfitMetrics. If you don't have a tool like ProfitMetrics, you can create, and correct me if I'm wrong here, you guys are definitely more knowledgeable on contribution margin than me, but I imagine you can create some sort of static snapshot like you would with a P&L report, where you look at a time frame and you're like, okay, I can find my product costs over this period, and then with that gross profit, I can subtract my ad costs over this period and get an idea of what the contribution margin is there. The risk is just that, well, for one, that takes forever. And it also is not something you can use for very long. You can't use it to analyze a campaign while it's going and base decisions on that, which is where you do need a tool that can help you figure it out in real time.
But it is all about the periods as well. Even if you do it yourself or you have a P&L from your accounting system, doing it often, because that's often what people make mistakes. They maybe do it every quarter, and then if there was a missed opportunity, they didn't take it. They got those numbers in too late. But also, as my story tells everything about, is even a quarter is a long time if you do something different that you weren't aware of, then it can be way too late. So it needs to be something that you do at least every single month, and make sure you have the stock count and so on, because many don't count their stock in, and then they buy in a lot of invoices or a lot of new products, but they're actually not in the warehouse yet, but they're not in the inventory count and so on. So it is a little bit difficult, but you need to at least have it every single month as a bare minimum, I would say.
I'm going to actually challenge that, and I would say that is too long of a period. I think having it, we do it on a daily level, but at least a week. Like if you lose 2 weeks, like you've basically lost a month. And so, and if you've lost a month, you're now 1/3 into the quarter. So we try to get it on a daily level, and this is where I think a tool like ProfitMetrics makes so much sense, because if you have to make those calculations, like let's say you're discounting some items, most brands know their baseline gross profit margin, but now you're discounting. What most brands don't take into consideration is that now your gross profit has completely shifted and you cannot use those fixed margins anymore. And so just being able to look at that on a daily level, we've seen promotions where the discount overrides the additional volume that a brand would do in sales, and where the contribution margin actually diminishes even though revenue is going up. And so I would say that, I mean, yeah, having it, I prefer to have it almost real time or on a daily level, so that you can look at it all day. Because also, how else are you going to, as an agency or as an in-house marketer, doesn't matter, how are you going to make decisions based on whether it's working or not?
Yeah, and true also, because as an agency, you're not always informed of what is happening. Yeah, you maybe know that they're running some sales because you need to be the part of driving that sale, but you don't know if they're suddenly liquidating or putting more products into the outlet, or they're doing something internally that they're not thinking is a part of marketing. But that you would suddenly see, hey, something is going down. It's not in the ad spend percentage, but it's on the gross profit level that we are making much less, and it's actually the product cost is much more of the revenue than normally. So you can also really act fast on things that you weren't normally aware of.
Well, the last thing that I wanted to discuss on this, and you mentioned agencies there, for the agency listeners to this who are on board, they like contribution margin, they think it'll be a better way to improve campaigns and overall businesses. How do you introduce that to a client who has been focused on something like revenue or ROAS? How do you explain to them what they should do to start using contribution margin?
I can jump on that. Just like Michael, actually, we have a spreadsheet. It's not as fancy, but it has items, it has costs, it has revenue, and at the bottom, it has essentially your bottom line. So I think just sitting down with customers and being like, let's have an open and honest discussion. Even if you are or aren't getting a part of the performance on the profit as a retainer, or however you're looking at it from an agency perspective, I think it's still very important. And it's a really healthy discussion that will also improve your relationship with the client, because it will show that you really care about the business. Because otherwise you wouldn't even look at it, right? And that's also a key tell, right? If your agency doesn't really look at it, do they actually care about your business? That's also a fair question to ask. But just sitting down and be like, hey, why don't we just go through last month's number? If you've never done this before and you want to start out, right, which was the question, let's just look at the ad spend across your different paid media channels. Look at your revenue. Look at your overhead. Like at least once do that. Look at the overhead and everything they're paying in SaaS tools, the customer service team, the sales team, the office, everything, and then just look at the bottom line, and then just ask them, this number that we got to at that last row, are you happy there? And the answer will never be yes. So right there, it's like an immediate action for them to be like, all right, let's do something about it. And they say, cool, this won't fix everything, but this one thing will be one step along the way to start fixing it. And that can be, for example, using POAS in your paid media channels. But just having that discussion, in my opinion, is the best first step.
Okay. So have the discussion, sit down, show them the numbers, and start showing what you can do with it. All right, gentlemen. Well, this has wrapped up the discussion that I wanted to have today on contribution margin. Frederik, Damo, Michael, I want to thank you guys for joining me here today in a quick summation of what we discussed today. Keep your cash flowing, keep your pipeline sponges wet, and start focusing on contribution margin, the thing that everyone can contribute to. Pun still withstanding there. I'll work on it. I'll get back to you. If you guys have any questions for any of our panelists, please leave them in the comments below, and everyone will be going through to answer them as quickly as they can. Until next time, I'm Sam Kellett, and thank you everyone for joining and watching this roundtable.